What is up, guys and girls? What a crazy time in the market it has been last week and starting out this week. The goal of this video is to get you into a state of knowing if you need to pull some of your funds out of the market or put more into the market. A lot of people are all the way in, some people are all the way out, and we have a very select few who are around half and half. So this video should give you more information on if the market is going to continue trending up or continue trending down by the information that I have seen so far. So first off, this first image, we have wiped out $740 billion on Friday, and then we rose $500 billion on Friday almost immediately after. All of this is just short term, guys. If you are a long-term trader, and you should be a long-term trader, short-term trading is very risky. You can get better reward, but it's extremely risky, and not everyone can win the game. On a long-term basis, everyone can win. It's very hard for you to lose a long-term basis unless you just pick a terrible stock. So all of this, especially all of this Middle East thing, it's short-term. It's not going to be here 20 years from now. Very high odds that it isn't. We just had our largest treasury buyback in history, coming at $15 billion. This should help the market just a little bit when it comes to liquidity on a dip. This was also Friday, when right after things were selling off, so it will probably be in effect for a little bit. So we did have better liquidity from the dip, which will impact the market just a little bit. These are the amount of oil reserves that the world has when it comes to global oil inventories. And this is COVID, and we saw a rapid decline in COVID. I'm showing you this to make you feel better. Okay, this is a very big problem that's happening, and it would affect the market, and it is currently. But I wanted to show you that it is not going to destroy Earth, right? This happened all throughout COVID, and then it was flat, and then we were okay for a couple of years, and then we were able to get some stock just like we did before COVID. We didn't get as much, but we were able to get enough stock, build it all back up, and now we plummet again because of this. These recent times. And even if we go all the way down, we're still at 72,000 out of 9,000. We have a long ways to go when it comes to like getting critically low. When it gets critically low, we're at 3,000. So we're not even halfway there yet. We have some space. We have a buffer still, guys. We're okay. And then it will be okay. It will be okay after this, and we'll continue to raise it back up to around the 8,000s, assuming that we don't have conflict after conflict after conflict. But we're not doing, this is not the end of the world, guys. Okay. This should make you feel way better. Earnings season is going to be massive this week. We have a lot of very big, Magnificent Seven companies on the 29th and 30th. These are going to set the tone for the rest of all earnings seasons. The ones I've highlighted are the ones I'm going to look at: Google, SoFi, Microsoft, Amazon, Meta, and Apple. These are all the other ones that will, or that have earnings and what you could watch out for. Also AMD next week. We are looking for that one. Excited to see what they can pull off, but focusing this week, we're going to have a lot of massive numbers to look at, and I will be covering most of those on Wednesday, Thursday, or Friday. So keep in tune for that. This is the estimates of the average earnings ratio, you could say. This is what we're looking at right here. We think that the earnings are going to be extremely positive from the average of what they have been. So the bar is set high, pretty much, in layman's terms. This can be a little dangerous, right? I don't have any historical data, or haven't found any, when we have set the bar high on earnings and it didn't hit the bar, what would happen? But it does create a little bit of a danger point. This is why the market hasn't completely collapsed with the Iran war type of thing, because our earnings are so close and they're projected to be absolutely phenomenal compared to average. And that is exactly why the market hasn't tanked yet. If earnings starts to look pretty bad, we might be in a bad spot. But I doubt that, honestly. I think that we're at least going to hit average numbers or slightly below average numbers. It's not going to be anything crazy because it hasn't affected the companies yet, right? So the bar is set extremely high for earnings seasons on this specific quarter. And ladies and gentlemen, I took this on Friday. We have set a new record for the public account. This is a banger of a day when it comes to AMD. We went from 330 to 350. We had a $1,200 day on one stock. Not four, not seven, one stock. I think we went up like 25,000 or 2,500 that day, which is another record. But what a run AMD has made, and I'm excited to see what their earnings are in the future. And it is still not too late to get in on AMD. I would be very careful on entering at the 350 range. It is high compared to where it was at literally last week at 200. But I would be watching that stock like a hawk. If it goes back down to 200, I would get it. If it goes down to 200, I'm going to get more. So be watching that one. That's a big one. As I said last week, I don't know if you guys remember, the average price target was 290 and the highest was 360. I told you guys, if it passes 290, it will shoot up into the 300s. And if it passes 360, we're going to be booming for the next couple of weeks. So far, we passed 290 and literally the next day it shot all the way up almost to 260. If we stay within that range, we still should be able to go up more. If we dip all the way down to 300 or 280, 270, then we're probably going to be up and down until we can get another run out. Just like we had here, we were just kind of flat, right? That could be a buying opportunity, but I'm already bought in, so I really hope it passes 360 soon. We will see. Right now, the market's mixed. I'm not going to lie. A lot of this news in this video is from Friday and this Monday. This Monday, the market performed okay. We had a lot of stocks that were positive and a lot that were negative. It was really a 50-50 split. So the market is confused on what to do and what's going to happen. Regardless, we're either going to start going up significantly or pummel our way back down. There's really no in between. We're probably not going to stay flat. But usually, when the SaaS stocks have been up over the past 4 weeks, we've had a little bit of trouble coming in. So I'm expecting a couple of red days this week, which is weird to say because the trend that I've seen over the past couple of weeks, when the stocks have gone up in the SaaS area, the market was down. And when the stocks have gone down in the SaaS area, the market was up. And you could see the trend here. So the market's been moving up, but now that SaaS stocks have started to make a turnaround, you could also argue that the market might start to flatten out. Obviously, this is just a educated guess from me. Just make note that it's not going to be solid green from here on out. We're going to have way more volatility until we figure out which direction we are going in. But keep in mind, right now, we have recovered fully from the dip that we were in, but we have also recovered fully from dips that we were in the past, even if it took a year and a half. And the points that we're in right now are the ones that I've highlighted here, and we still had a massive run before that. Even if you were to say this, for example, it went down and it went down again, but guess what? It went back up and it made us a greater significant run compared to the others. if it takes longer. So honestly, it is always a good idea to buy on the dip. So even if the market goes down, I'm going to be buying. If the market goes up, I'm going to be having fun with profits. So either way, it's a win-win for me. And that's exactly how you should be positioned. If you're scared and if the market goes down, you're too far in. If you are worried when the market goes up, you're not far in enough. All right. Or you're just greedy. You need to have a good enough ratio. That settles correctly in your mind, that gives you a sense of calm, that you know that you're okay. If the market goes up, you're going to make a lot of money. If the market goes down, you have enough money to put in to make money in the future. That's exactly where you want to be. And a lot of people, especially right now, we have a massive amount of money. Perfect timing. We have a massive, close to $8 trillion out of the market. So this can be a mixed signal, right? This can be very good if the market decides to go up, this could be very good. Some of these guys are going to have fear of missing out, and they're going to start putting cash in the market, and it will shoot up. But it also is bad, because these guys are also waiting for the market to go down. So if the market goes down 10, 20%, they're just going to load up on cash. So we're not going to have a crazy buying opportunity if the market goes down, because there's so much money on the outside of the market. Let's see. I'm gonna make sure I didn't miss anything. Yep. So this is just a stupid amount of money in the market. I want to say the market's worth close to $35 trillion. And if 8 trillion are set on the side with cash, like that's a 30%, that's literally a 30% raise from where we're at now, if some of this came in. So I would not be surprised if we have a lot of volatility in the short term, because of the amount of money that people have stacked up over the past couple of weeks with the market going down. If the market trends up, you're going to have some stack it in, you're going to have some pull out. And if the market goes down, you're going to have a bunch of them stack in and a lot of them pull out as well. That's just volatility. So don't be too worried about it. For me specifically, after checking it out, I am a little too far in the market. I'm comfortable this way because even if the market goes down, I'm just going to be able to put a percentage of money from the job that I'm working into my account over and over and over again consistently. So I'm not really worried about it. If you are retired or you don't have the ability to continuously put money into an account, then you want to be at around 10%, right? It's really whatever makes you feel comfortable. But for me, 10% is a solid number to where if you go down, you have enough to continue to DCA down for maybe 3 or 4 weeks. If you have 25%, that's even better. And anything around 50% is too much, right? You don't want 50% in cash, or else you're not even making half the gains that you could be making. I would say 30% is the highest you want to go. That's the highest you want to go, because let's say if you have a $100,000 account and you have 30,000 on the side, if the stock you own goes down 50%, you can put money in it for months, right? Sometimes stocks take 3 or 4 months to turn around, and sometimes years. But if that's the case and you continue DCAing down, you have plenty of money to play with. And I'm only at 1% right now. So I am going to stop all buying, even if there's a decent opportunity, until I have a minimum 5% cash on the side. And I'm adding $300 a week. That is how much I've decided to add into the account per week. Hopefully I don't have to add any more. If so, I'm completely fine with adding more just to boost my my cash reserves. I'm going to aim for 10%, but I'm not going to click another buy button until I have a 5% cash buildup on the side, just for a safety side of things. You never want to have 1% cash, especially if you cannot add anything into it. So I am invested into this market quite heavily. I've realized that, And so now I'm going to stop where I'm at. I'm at a good position right now, and I'm just going to start saving up money to where even if the market does start to go down, I could not save any of the stocks that I have, or not sell any of the stocks that I have now, and be completely fine buying them back over time. Ladies and gentlemen, thank you for watching this video. These stats have been killing me over the past couple of days. I'm so thankful for you guys and your support. And I hope to continue doing these. A little update on my personal side. I got a new job, so these videos are going to be inconsistent for the next couple of weeks until I can get used to the schedule. Hopefully, I'm going to aim for 2 or 3 a week, but we will see what happens. Sometimes, at minimum, I'm going to do 1 video per week. If it needs to be a weekly update, I got you guys when it comes to that. But just keep crushing it out in the market. Remember, all of this right now is short term. Every time we've gone through a dip in the market, it has been a short term problem. I mean, even this looked like the end of the world right now, but it's literally, it looks like maybe a 2% drop when you zoom out, right? Same thing with this. This was incredibly painful. This was like a year and a half of the market just going straight down, up, down, 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 up, down. And it still looks like a maybe 5% drop if you zoom out, right? So look at this one. The most recent one looks like nothing happened. And now we're all the way up and we're like, the oil and everything. Guys, we're completely okay. Unless the dollar completely crashes or the end of the world happens, everyone's 401k is going to burn in the end, okay? That's something I like to think about. Even if my portfolio goes down to zero, everyone's retirement goes down to zero as well, because it's not just me in the market. Every single person is in the market. I'm just going to be affected by it a little bit more. So honestly, the market's going nowhere anytime soon. This is all short term. Keep your head up, keep your hands strong, don't be selling, and I'll see you guys in the next one.